Good afternoon, everybody. Welcome to the second quarter 2023 market update for Tobias Financial Advisors. We really appreciate your time being here. We have a lot of really good information to share with you today. Within the options below, you'll see that you can download some of the slides. There should be 5 different attachments you can download today. You can have all of the slides from today's presentation plus a little bit more. But we're really excited to share with you some of the information we have and how the market's been doing. But let's get into it. We have, just to start out with, we have some just disclosures and housekeeping that we want to show before we get into the actual meat of the presentation. A little bit of background on Tobias Financial Advisors. We were founded in 1980. We have 600 million in assets under management, about 20 people that work here right now, a really great group of people here in South Florida, 75 years of experience. And we do have our financial designations. We have certified financial planners, we have CPAs, we have chartered financial analysts on the team. We have a lot of really great designations, a lot of really talented people in our organization, and really good group of people. And presenters for today, myself, I'm Chad Neesmith. I've been with Tobias for about 2.5 years. I do trading and research for the firm, and I present on this quarterly webinar whenever there's a spot for me. And today we have a special guest from Vanguard. It's Natalie Marby Romero. Natalie, how are you doing?
I'm great, Chad. How are you today?
Doing great, doing great.
So just to share a little bit about my background, Chad, so your participants know who's with them today. I'm a senior portfolio specialist here at Vanguard. And what that means is basically I focus on our equity strategies, and I share information about what our portfolio managers are thinking, whether it's international, which we're talking about today, or U.S. equities. I've been at Vanguard for 2.5 years, but I've been in the industry for over 25, most recently at PNC Capital Advisors, which is a subsidiary of PNC Bank, on a small cap team, and before that at Morgan Stanley on an international equity team.
That's great. Thank you so much for being here. I'm really excited about what you're going to share today. I'm going to give some really good insights to our clients and people that are watching the webinar. So thank you so much.
Thanks for having me, Chad.
Of course, of course. Before we get into the actual meat and bones of the presentation, this is just a slide we put in every quarterly webinar. This is just a reminder to focus on what you can control. No one can forecast the market. No one knows where it's going to go year to year. But what we can control is we can diversify our portfolio. We can minimize our taxes. We can reduce our expenses along the way, and really just create a plan that you can follow for your financial goals. And you do that by working with your advisor, following up with them often, and staying in touch with them. And you really just want to focus on your plan. So just something to keep in mind as we get into some of the data today. Today's agenda, we've got a nice lineup of stuff we're going to talk about. We're going to start out with a 2023 market review. We're going to go into the quarter returns for different asset classes. We're going to talk about asset classes and how they've done this year. Then we're going to go into some specific topics where I'm going to talk about the U.S. economy. Natalie's going to cover international investing. I really like what she's going to cover today. And then I'm going to talk a little bit about bonds and money markets. You may be hearing about how money markets are yielding a lot right now. Maybe banks are paying you a little bit on returns. I'll talk to you a little bit about that. And then we're going to get into how we see 2023 shaping out, some things that we're looking for, and then how we're positioned generally in portfolios. We'll close out with a little bit of Q&A, and then that'll be our webinar. So starting out, historically, the market, we're having a really good start to the market this year. We're up 16.9% through the first 6 months of the year. It's the 14th best start for stocks going back to 1926. So out of 98, this is the 14th best start that we've seen. It's really nice to see that on the right side of your screen, if stocks are up, historically speaking, they tend to be up a little bit more than if they start out negative on the year. So that's really good for really good news to see, but it's not something that we can really count on because past performance does not guarantee future results, as we know. But it's still nice to know that we've had really strong performance in the stock market. We've had really good GDP data this year. This time last year, a lot of people were expecting recession. We've seen a really strong consumer come out of the woodwork, and they just keep spending and they keep GDP elevated. That's kept optimism in the market, and we've had a 17% return in the first 6 months. So overall, portfolios are looking good. Returns are looking pretty good, especially compared to last year, since 2022 was so challenging. So that's really good that we're seeing such a really good start to the market this year. Looking at just the second quarter of 2023, We can see the U.S. stock market is up a little bit over 8% for the 3 months for the second quarter of the year. International developed stocks are up about 3%. Emerging markets are up a little bit, but have had a little bit of trouble with China. They've had a little bit of a rocky reopening with COVID, but overall they're still positive for the quarter. Real estate is still positive, even though we've had some concerns about commercial real estate and then the tightness in the housing market. But it's still positive, so overall looking good. U.S. bond market down a little bit for the quarter. We've seen some really good economic data that's kept interest rates high. That puts pressure on the bond market. We think that overall it's a positive. We are getting higher interest rates on our bond investments going forward right now, so it's still good news for investors. But for the quarter 2022, it's a really strong quarter, and we're really happy with the results the market's put together for us. Going to look at asset class returns. This is almost completely all green, as you can see in your screen, with the exception of a couple of outliers at the bottom. Last year, it was basically a mirror image of this of this screen. If we were looking at December of last year, leading the year as of June 30th, it's the Nasdaq, so it's up 32% this year. Last year, it was down about 32%, so it's rallied back. These are companies like Apple, Microsoft, Nvidia, Tesla, a lot of companies that have been, people have been really excited about the prospects of artificial intelligence. So they performed really well coming out of such a bad year of 2022. But it really is, everything is done really well when you go down the list until you get down to the bottom where we have crude oil is down. If you remember, last year we had really high oil prices. So it seems, oil being down may not be bad for consumers right now. And it's translating into, good consumer inflation data. And probably since people are paying less at the pump, they're willing to spend a little more elsewhere. So it's helping support the economy. And then I mentioned earlier that China's down about 5%. It's had a lackluster opening it's had, a tough reopening with COVID. People have, hoped more from China with their COVID reopening because they were slow to open. And so, consumers are still a little bit on edge about their spending. They may be delaying some of the bigger spendings like appliances, new vehicles, things like that. But we're really not sure what the government's going to do to shake out. But overall, we think that in the long term, China is a good investment, and we do include it in our portfolios. So overall, this is a good start to the year to date for asset classes. And it's really nice to see everything, almost everything in the green for the year. So that's good news. I'm going to transition right now a little bit about the U.S. economy. I got a couple slides here just to get you kind of caught up on what's going on so far. And then we'll transition to Natalie to talk about international investing. You may have heard that inflation data is looking really good, or we've gotten some promising inflation data over the last couple of months. This is a chart that goes back to 1973, where it compares headline CPI, which is inflation, to core CPI, which is inflation minus food and energy prices. The Federal Reserve pays a lot of attention to the core inflation numbers. Headline inflation numbers may be what you see when you turn on your local news or your national news for that matter to see what's going on with inflation data. But as of June 23rd, the headline number came in at a positive 3.1%, which is it's really good considering just a year ago we were at about 9% headline inflation. So the work the Federal Reserve has done to really put pressure on inflation through raising interest rates is really panned out well. We do have a little bit of tightness still in the housing market. I know that there's a lot of first-time home buyers, including myself, that are really hoping prices come down a little bit, or we get some kind of relief when it comes to first-time home purchases, but we can't count on that. But rents and home prices are putting upward pressure on core CPI. That'll take a little bit of time to work out, but it's still promising. It's promising that we're getting 3.1% inflation number right now. And we do think that over time, it'll go closer and closer to the Fed's 2% goal. However, that's a long ways away just because we have this housing pressure that we're seeing right now. I think the Federal Reserve estimates we'll get to 2% inflation somewhere in the 2025 area. But right now, 3%, that's pretty good when you compare it to 9%. We are still seeing some food inflation, as you can see, 5.7%, but energy down 16.5% year over year. That's a really great number down here in this box or in the top right. Overall, that energy CPI is putting a downward pressure of about 1.5% on total prices. So it really is helping consumers spend and save a little bit more than they were this time last year. So that's great news. I do want to cover this slide. It's a slide that I pay a lot of attention to and have been for quite some time. This is showing personal savings for consumers. And this is kind of like the health of how consumer spending is looking going forward. As you can see, this chart goes back to 2018. And the big spikes in personal savings represented a lot of the COVID money that hit consumers' pockets during that time frame. A lot of that money went into savings, and they're slowly spending it down. So you can see we peaked consumer savings at $2.1 trillion right around the middle of 2021, and consumers are slowly spending this down. They're dipping into their savings to spend a little bit more. We still have about $0.4 trillion left in excess savings if you were to compare it to the trend line, but that's going to be coming to a head. It's something I'm paying really close attention to. If we don't have this excess savings for consumers to lean back on, we may not see such strong consumer spending over in the next 6 months to a year. We also have another cliff that's coming up, which is the student loan repayments that are going to kick back in October. On average, the payment is about $200 or $300 a month, which may not seem like a lot, but for a consumer that makes $70,000 a year, it's like a 4 or 5% pay cut when you factor in the monthly payment's going to come in. So, student loan payment coming due, plus this kind of a slow drain in savings, it's something I'm paying attention to. And we obviously want a really strong economy, but we're really paying attention close to consumer spending over the next 6 to 12 months. So with that, I'm going to pass the baton to Natalie to speak a little bit about the international landscape and talk about international investing.
Great. Thanks so much, Chad. I appreciate it. And I just wanted to reiterate that there are 3 articles that you can download on international investing that will include the concepts that I'm speaking with you about today. So if you want to read a little bit more, there's some material for you. I think the best place to start, if we can advance to the first slide, Chad, is really just talking about the significance of the international markets, because I think, I'm as guilty of it as anybody else, focusing a lot on the US. That's where we live, we're here. But if you can see in this top graph that Chad has, and it's one of the articles that you can download and look at your leisure, you can see that it's showing the composition of global equity markets between the US and international. And on the far right, it shows where we are right now. And international markets are 40% of the equity markets. It's significant. So if you were to choose not to invest internationally, you're missing out on just purely a huge chunk of the market, but then also some unique company opportunities and a wider array of economic and market forces, which, harkening back to a point that Chad talked about, gives you diversification in your portfolio and protects from some of the downs in the portfolio potentially. And if you look at the bottom chart, what it shows is the sector allocation differences between US and international. The US is the dark green, and the gray is the international for that bottom slide. If you look on the far right, it's something that you hear everyone talk about a lot, right? The concentration of technology in the US. But it doesn't mean that there isn't any in international. You can see that the green bar is healthy, it's just less so. And then the same for healthcare. And what's particular about those 2 sectors is they're more growth oriented. If you look on the left-hand side, you'll see that international has more in financials and banks and materials, and those tend to be more value sectors. And that's also important from the perspective of, the markets where we've been and where we're going. If you can move to the next slide, Chad, I think it'll help to emphasize that point. If we look on the left-hand chart, this is Vanguard's forecast for US equities in that shaded area, and the dotted line is the median of that forecast. And we at Vanguard do 10-year forecasts because, as you probably know, we advocate for long-term investing. Plan what you're trying to achieve with your investments, set an asset allocation, and invest for the long term. You can revisit it from time to time if things change within your plans, but as Chad said, focus on the things you can control. which is your plan and your asset allocation. You can't really control what's going on with the market, and certainly that shows in our forecasting, because you can see that the US, over the last decade or so, has outperformed where we thought we were going to be. And if you look on the right-hand side, you kind of see the opposite for international equities. We had expected international equities to outperform more than they have, right? Because that dark green line is below the shaded area of our forecast. And I guess I want to take a moment here to just acknowledge that the diversification that Chad talked about, and we certainly believe in as an investing principle at Vanguard, didn't work over the last decade, right? With that low interest rate environment that we were in for so long after the global financial crisis, it really just fueled those growth companies, whether they had earnings or not. It was really inexpensive to borrow capital and try new things in your company. There wasn't a lot of downside risk. But the markets have changed, right? We've all seen it. The interest rates have gone up significantly, right? And we're in a more normal interest rate environment. And what does that mean? It means people are going to have to be a little more circumspect when they borrow money, capital for their companies. It also means that maybe those value companies, which were on the left side of the sector where international is tilted more, would tend to do better because they have more near-term earnings to offer for investors, and also in a lot of instances, dividend income. So the environment has changed. So that's why we're saying it could potentially be the time for international, right? The environment has changed. We expect changing market leadership. If you think about it, the markets are cyclical. And you might have heard people talk about the 2000s, 2000 to 2009 as the lost decade. Well, it depends upon your perspective. If you're talking about the S&P 500, it sure was. You put $1 in the market in 2000, and it would have been worth just a little bit less in 2009. But if you had put that money in the international markets, it would have been worth a little bit more, because the international markets returned 4%. So you not only got a diversification of return in that decade, in addition to just overall diversification and volatility. So maybe if we go to the next slide, I can talk a little bit about our forecast for the next decade and why Vanguard suggests that international equities would outperform US equities. Let me break this chart down for you. On the left-hand side is our projected annual return for the US markets. So we're forecasting for each of the next 10 years that the US markets would return on average 5.1%. All the way on the left-hand side, we have what we're forecasting for the international markets outside the US at 7.3. So the difference there is about 2.2 percentage points per year. Where's that going to come from? Well, if we look at kind of the sum of the parts there, you can see we expect valuation expansion a little bit in international. You've probably heard a lot of people talk about how the international markets are undervalued. So we would expect, the price that people are willing to pay for international earnings to go up a bit, and maybe on the US side to come down a bit because the valuations are high in the US. And then in the next, the reason that number is negative, what we're saying there is we do actually think that earnings growth in the US will be a little bit better than internationally. And then the next factor is dividend yield. You may know that international companies tend to pay dividends more often than US companies, and the dividends tend to be higher. And it just is a nature of the international market that their shareholders, that's an expectation of that market. And so they tend to pay dividends more, higher, and do less share buybacks. And then the last is foreign exchange return. You've probably heard so much about the strong dollar, particularly last year, but really the dollar has been strong against the majority of currencies for over the last decade. But what you saw last year in particular is that when we started raising interest rates in March of last year of 2022, the Fed, we were ahead of most of the rest of the world. I think mostly except for some smaller countries in Asia and Brazil and Peru. So what happened then? Well, that means the money is flowing to the US, right? And the dollar strengthens. But then what we saw, we saw the Bank of England start to raise, we saw the European Central Bank, they started raising in July. So we're forecasting that we're a little bit ahead of them. We're probably going to cut rates before they will. And how that will translate into returns is that will mean that the dollar will weaken, and that will mean that international returns will be higher when you're taking them from their local currency into US dollars for American investors. So maybe a good place to end would be, Chad, if you could advance one more slide.
Yeah.
This is one of my favorite slides because, it makes me think about, where do I spend my money? And if I think about it, and if I were to go into my pantry, I'm a chocolate lover, so there might be some Nestle Crunch in there. And as much as I think of Nestle Crunch as something from my childhood, it is not a US company. It's based in Switzerland. And for any of you that were unfortunate enough to get the flu this year, and we're thankful for having Tamiflu because it shortened, the length of the flu for you, well, you have Roche Pharmaceuticals, which is based in Switzerland, to thank for that. And then, how many people, if I could see you, I can't, so I'm sorry, but I'll raise my hand. I have a Samsung TV at home. You too, Chad? Right?
Yeah, I do.
Yeah. And again, Toyota. We see so many Toyotas on the road, right? But it is an international company based in Japan. And then the last one on there is Meituan. And this may be one that you don't know, but it is a Chinese company. So back to what Chad was saying about China, this company is an equivalent, I would say, of Grubhub, right? Meal delivery. Well, just to compare it to Grubhub, if you looked at the statistics of how many meals a day that Grubhub delivers, it's about 600,000. That's impressive, right? Meituan delivers 30 million. So yes, China is in a slump for some time coming out of COVID after the initial kind of uptick, but it's a large economy with a lot of consumers, and I think over the long term, as Chad said, I think there's a lot of opportunity there.
Well, Natalie, that's great. I really appreciate you sharing everything today. Really good information for our clients, and thank you so much for your time and expertise in this area. I really appreciate it.
My pleasure.
Of course. I've got just one more slide talking about short-term money markets. I know that we generally, they're paying a lot right now. Money markets are paying about 5%. 6-month treasuries about 5.5%. So you may be tempted to put a large amount of money in short-term assets, but this is a really good slide for you to review and to think about. Starting on the far left, number one is when shorter-term interest rates are higher than longer-term interest rates. This is known as an inverted yield curve. That's currently what we have right now, is an inverted yield curve. Just going back in time, money markets performed at about positive 4%, which is still good positive performance. Short-term bonds at about 5.1, and then the U.S. core bonds gave us about a 7.8% return, and that was due to falling interest rates over time. So right now, interest rates may be high, but going back in time, interest rates throughout history have fallen whenever we get towards the end of the interest rate hiking cycle, and that may be where we are right now. It's hard to tell. So in our portfolios, we have exposure to all three of these buckets. So we have a little bit of really short-term investments. We have some short-term bonds at like 5.1%, and we have a little bit of exposure to U.S. core bonds because we don't know exactly where interest rates are going to go, and it helps hedge the risk of that. Now, there is some risk in investing in short-term money markets, and that primarily is reinvestment risk. And if you recall, just a couple of years ago, money markets were not paying anything, and the 10-year treasury was at about 0.5%. So I'm not saying that we're going to enter that environment in the future or near-term future, but it's a possibility. So you could, if you put a lot of money in short-term instruments, next year, if interest rates were to fall, then the yield wouldn't be there for you going forward. So that's something to really consider. If you look at number 2 and 3, this also hammers down the benefits of diversifying your fixed income in your portfolio. The average 12-month performance following a Fed rate hike, and when you compare cash to short-term bonds to core bonds have done historically a lot better than cash, which is money markets. And then core bond performance is generally better when Fed funds is greater than inflation, and that's where we are right now, as we have falling inflation and we have a really high Fed funds rate. So it's just history. We're not saying this is going to happen, but it's good to review how things have played out in the past. So I just want to share that slide with you guys. I feel like this is a really powerful slide to review because it's the environment that we're in right now. So if you have any more questions about your fixed income allocations, feel free to reach out to your advisor here at Tobias or contact us if you're not a client, and we really appreciate it. I want to close out a little bit with some points of optimism as we wrap up, and then some points of caution, and then just general portfolio positioning. So optimistically, labor market is strong right now. Last month we added 209,000 jobs, 3.6% unemployment rate. Labor force participation continues to tick up with people that are working age. We are seeing people that are 55 and over still haven't really come back to the labor force since COVID, but for the core of the labor force, people are participating, people are looking for jobs, and the economy is adding jobs. So that's great. That's great for our GDP. That's great for our overall economy. As we covered earlier, inflation is showing a lot of improvement. 3.1%, as we talked about earlier, is the last reading. We do think we're a little bit away from 2%, but 3% is a lot better than 9%, and we hope that it'll stay that way. And it's looking like it probably will be hovering in the 3 to 4% range for a little bit of time. Wage growth. We just got recent news that wage growth is outpacing inflation for the first time in over 2 years. So as of last month, we had a 1.2% increase in real wages, meaning wage growth minus inflation. So that's really good for consumer spending, and that's really good news for investors. We have had strong economic data, stronger than expected for this year, strong GDP, strong spending, good unemployment data. So the strong economic data is going to translate likely to good earnings season. Earnings season kicked off last week with banks, and we are seeing some good earnings from the banking sector, financial sector. We'll continue to monitor that situation, and just monitor earnings and keep an eye on the market for you. So points of caution: the Federal Reserve is still tough on interest rates. They're still trying to put pressure on inflation. They're still raising rates. We're forecasting some more rate hikes towards the end of the year, so that's something that we really want to pay attention to. 2% inflation, that's the Federal Reserve's goal. It's a long ways away. The Federal Reserve Chairman Jerome Powell has acknowledged that. Again, he does think it's probably 2025 until we get to 2% inflation. So they're going to be tough on interest rates for the foreseeable future. As we covered earlier, consumers may be getting low on savings, which translate into maybe lighter spending going forward. It's something that we're monitoring that goes along with the student debt payments that will resume in October. That could put some pressure on spending. However, we've gotten some really good oil prices, so we hope that will translate and offset some of this in the future. I just have one slide on portfolio positioning, just to give you an idea of where we are positioned in different asset classes. In fixed income, we are shorter duration, meaning we have bonds that are maturing closer in time than would be compared to the overall bond market. We do that because it is paying a higher yield, and it's also a little bit less risk for us right now in portfolios. And we do like the greater certainty of return in our fixed income sleeve in the portfolios. Considering we had such a tough 2022, we do think it's a good place for us to be in fixed income. We also are keeping bonds high quality, so really good companies. We don't want to take any risk in high yield right now with the threat of a possible recession down the road. So we just don't think we're getting paid enough to take risk in high yield bonds. And that's been that way for some time. For stocks, we're just looking to rebalance. We're maintaining our international exposure, and definitely maintaining it after Natalie's presentation and her information. But we do like international, and we do like the diversification benefits it provides, and we're going to maintain that in our portfolios. And we're keeping our quality company tilt. We do like quality companies, good balance sheets, not a whole lot of leverage, good earnings. We are keeping that in the portfolio. On the opportunistic side, so this may be in your tactical sleeve in the portfolio, we're still defensive in this area. There is a possible recession in the future. We don't know when it's going to be. It keeps getting pushed back. This time last year, we thought we were going to be entering recession about this time. But right now, we're taking advantage of the short-term interest rates that we have. Money markets are paying 5%, so it's a nice place to sit and sit and wait for a little bit. But definitely, as we covered earlier, don't put all of your eggs in one basket. But it's good to tilt towards that and lock up a good, consistent return for the year. But we are exploring in a move to risk assets in that bucket. But time will tell, and we're constantly researching new ideas and taking gauge of the economy and the markets and seeing if we can get really good opportunistic trade for you and to get that allocated in the portfolio. That's general portfolio positioning. We do generally have some time for some questions. I do have a question for Natalie with her presentation. Natalie, when investing internationally, does it make sense to exclude certain countries? We've had that question from clients in the past where they want to possibly stay away from China or stay away from maybe the war in Europe or something like that. Is it a good idea to exclude countries when investing internationally?
Thanks for that question, Chad. I get that question a lot as well. And as you probably know, at Vanguard, we're strong believers, as are you, in diversification. And we believe it works best when you buy, companies across multiple industries and include companies of all sizes, because this really helps to moderate the ups and downs. And specifically as it relates to excluding a country, I'll give you an example of questions I was getting last year around the March timeframe, right after Russia invaded Ukraine. I was getting questions from clients saying, why are your active managers investing in Europe? Europe they have the war in Ukraine. It's going to bleed into the rest of Europe, and they have an energy crisis. There can't possibly be any good coming out of investing in Europe. And yet, if we look at the returns of Europe, even in US dollars, from January 2022 through April of this year, it outpaced the US by over 6 percentage points. And so who knows what the future brings? We don't have a crystal ball. And if you're going to exclude something from your portfolio or come out of the market, you have to time it right twice. When do you come out and when do you go back in? So I go back to what we talked about at the beginning. As you said, have a plan, set an allocation, and invest for the long term.
Natalie, that's great advice. Really great advice. And I agree with you on that. And thank you so much again for your time today, Natalie. I really appreciate it. Thank you so much for everyone attending this webinar. If you have any questions, please reach out to us, reach out to your advisor. We'll be happy to take them. And with that, we'll see you in the next webinar in the next 3 months. Hope you guys have a great afternoon and a great rest of the week.
Thank you.